안녕하세요. 실천적 투자자입니다. 기존에 실천 투자자 채널을 운영 중에 있는데요. 그 채널이 보통 당장 살 종목 위주로 말하는 경향이 너무 심한 것 같아서, 근데 어떻게 보면 그 이제 결과론적으로 중요한 내용이긴 하긴 하지만, 기저에는 왜 어떤 종목을 사야 되는 건지, 투자 생활을 어떻게 해야 되는지, 또 기간은 어떤지, 그런 거에 대한 철학이 좀 중요하다고 생각이 듭니다. 그런데 이제 개인이 경험하기에는 주식 투자라는 게 기존에 선배들이 있을 거 아니에요. 그 선배들께서 저희들한테 이제 조언해준 내용을 엮은 책들이 있어요. 네, 저도 처음엔 책들로 큰 도움을 받았고, 지금도 예전에 읽었던 책을 읽다 보면, 내가 잘못 길을 가고 있었구나, 이런 깨우침도 있고, 그래서 아직까지도 책을 계속 읽고 있는데요. 그래서 책 내용이 어떻게 보면 저희 좀, 필요 없이 겪을 그런 안 좋은 경험들을, 많이 단축시켜 주기도 하고, 좀 어렵게 갈 길을 좀 쉽게 가기도 하고, 뭐 깨우침을 되게 많이 주는 내용들로 이루어진 그런 선배들 조언이 많거든요. 그래서 항상 중요하다고 생각을 합니다. 물론 이런 주식 대가들 책을 설명해주는 유튜버께서도 계시는데, 조금 제 개인적인 생각에 좀 미흡한 점이 없지 않아 있더라고요. 그러니까 그걸 직업으로 한다고 하시는데, 제 이제 전업 투자 입장에서는 좀 더 다르게 해석도 가능하고, 좀 중요도를 좀 강약을 두고, 좀 더 아쉬움이 좀 남기 때문에, 제가 그 아쉬운 면을 제 스스로 대신 하고자 이번 채널을 만들게 됐고요. 주로 제가 좋아하는 책들, 저한테 큰 깨우침을 줬던 책들, 그리고 주식 투자라면 필히 읽어야 할 책들 위주로 선정을 해서, 우선 지금 대부분 현재 투자를 직접 하신 분들이 많거든요. 그분들의 동영상도 보면서, 그분들이 가지고 있는 철학도 엿보면서, 저희들한테 도움을 주는 그런 시간을 갖고자 하거든요. 그래서, 선정은 이제 물론 제가 유튜브를 애초의 목적이, 제가 이제 원래 유튜버가 직업은 아니잖아요. 제가 이제 전업 투자인데, 이제 어떤 유튜브 하는 핑계로 공부도 하고, 소통도 하고, 여러 가지 목적으로 시작한 거라서, 지금 제가 최근에 가장 꽂힌 책이, 예를 들어서 이제 안전마니저라는 세스클라만 책인데요. 그 책을 필두로 해서 여러분이 뭐 다 극찬한 책들 있잖아요. 뭐 투자에 대한 생각이라든지, 뭐 월가 전설이라든지, 뭐 여러 책이 있는데, 그 책을 한 권씩 격파해 나간다는 생각을 가지고, 좀 깊은 내용도 다루고, 또 어떤 의미 있는 구절일 때가 있을 때는 제 개인적인 생각도 덧입혀서 동영상을 만들고자 하거든요. 뭐 이게 지금 엄청난 많은 양을 생각은 아니고요. 물론 제 개인적인 주관적인 생각이 많이 들어갈 것 같아요. 제가 필요한 내용이 여러분한테도 필요하지 않나, 이런 생각을 가지고 하는 거니까요. 몇 명을 할지, 몇 권을 할지는 아직 미확정이고요. 우선 시작하고 나서 좋은 방향이 어떤 건가, 긍정적인 효과가 어떤 식으로 해야지 더 좋은 건지를 저한테도 도움되고 여러분한테도 도움되는 내용 위주로 엮으려고 합니다. 물론 처음에 실천 투자자 그 채널도 힘들었는데, 물론 지금도 힘듭니다. 이것도 쉽지는 않겠지만 그 채널과 좀 성격을 달리해서 할 필요가 있기 때문에 채널 새로 만들어서 시작을 합니다. 첫 번째 그 투자자는 세스클라만이고요. 이 책은 지금 뭐 우리나라에 전식 출간 안 됐지만 뭐 갖고 계신 분도 있고 하신데, 아무튼 거의 뭐 실전 투자자라면 꼭 읽어야 할 책이고요. 굉장히 도움된 책이니까요. 제가 뭐 횟수에 구애받지 않고 시간을 구애받지 않고 조금씩 진도를 나가도록 하겠습니다. 아무튼 뭐 여러분한테 조금이나 도움이 되길 바라고, 저도 도움이 받고자 하는 거니까요. 아무튼 좋은 시간을 함께 가져갔으면 합니다. 감사드리고요. 우선 이분에 대해서 현존하신 분이니까 관한 동영상이 있거든요. 그 동영상도 듣고 그 다음에 책을 진도를 조금씩 나가도록 하겠습니다. 아무튼 뭐 좋게 봐주시고요. 아무튼 감사드립니다. 시작하도록 하겠습니다.
First of all, I wish I'd met Ben Graham. I never was fortunate enough to do that. I think Warren captured the idea himself in his 1964 article, right. The Super Investors of Graham and Doddsville. Right. And in it, he talks about value investing is like an inoculation. You either get it right away or you never get it. And I think it's just true. I actually think there's a gene for this stuff, whether it's a value investing gene or contrarian gene. I think that everybody appreciates a bargain, but when the market's going down, most people overreact and get scared. My stock is going down, what am I going to do? So if you're buying a sweater and it goes on sale from $400 to $150, you get excited when you get to the store. But if you have a stock or you bought the sweater at $400, maybe you're not so happy. So I think for me, it's natural, but for a lot of people, it's fighting human nature. But it is true, it's what Warren Buffett said. When you find out about it, it's like being let in on this little secret. And so if you can remember that stocks aren't pieces of paper that gyrate all the time, that stocks are fractional interest in businesses, it all makes sense. It's almost like you have to slow the game down, like they talk about baseball speeding up on you. You need to slow it down. I can buy this thing for a huge fraction of what it's worth. What am I worried about if it goes down a little bit more?
Okay, but so what's the gift here, knowing what it's worth?
I think that the analysis is actually the easy part. When I speak to business school students, I tell them investing is the intersection of economics and psychology. The economics, the valuation of a business is not that hard. The psychology, how much do you buy? Do you buy it at this price? Do you wait for a lower price? What do you do when it looks like the world might end? Those things are harder, and knowing whether you stand there, buy more, or something legitimately has gone wrong and you need to sell, those are harder things, and that you learn over with experience. You learn by having the right psychological makeup in the first place.
Well, stop. What's the right psychological makeup that you have?
So
patience would be one.
Willing
to sit on cash would be another.
Value investors have to be patient and disciplined. But what I really think is, you need not to be greedy. If you're greedy and you leverage, you blow up. Almost every financial blow up is because of leverage. Yeah. And then you need to balance arrogance and humility. And I'll explain what I mean. When you buy anything, it's an arrogant act. You're saying, the markets are gyrating and somebody wants to sell this to me and I know more than everybody else, so I'm going to stand here and buy it. I'm going to pay an eighth more than the next guy wants to pay and buy it. That's arrogant. And you need the humility to say, but I might be wrong. And you have to do that on everything.
But are you different than Warren in terms of how Warren has evolved and how you have evolved? Obviously, I think Charlie Munger had some influence on Warren in understanding to not just to look for the classic example, the cigarette butts, but to look at things that were reasonably priced with the belief that they could be, that there still was a margin of safety.
First of all, a lot of my Charlie Mungers are out here in the audience,
yes.
So a lot of people here that I bounce ideas off of, and we share thoughts.
How have you evolved? Is my question.
Warren evolved from.
Is it different from Warren?
Warren evolved through 3 stages. He went from buying cigar butts and getting the last few puffs for free, to buying great businesses at really cheap prices, to buying and holding great businesses at so-so prices, and maybe even this new area of buying weird securities from crappy businesses at better than market prices,
Right.
like B of A
Right,
preferred or whatever. I'm still in phase one. We're still buying cigar butts. There's a good business there in buying them, and it's a lot of fun.
And that's what you're proud of.
No, I feel like I have stunted growth, Charlie. You know, you know what? I think Buffett's a better investor than me because he has a better eye towards what makes a great business. And when I find a great business, I'm happy to buy it and hold it. Most businesses don't look so great to me.
But he also doesn't, I mean, he is not really focused on the gyration of the stock every day.
Me neither.
You're not either.
I don't have a Bloomberg on my desk. I don't care.
You don't have a Bloomberg on your desk?
No.
Because you don't...
Mike makes enough.
What's on, yes, I know. But what's on your desk then? A phone?
Giant piles of paper that are at risk of falling on me at any moment, and I have a computer and a phone.
Yeah. So tell us about your desk.
Half-filled water bottles.
Yeah. I mean, but you sit at a trading desk. I mean, when you're not meeting either clients or people that are going to give you some information that might be relevant to what decisions you have to make, you're sitting at a trading desk.
Thinking big thoughts.
What, are you really? Are you? It's not so much because you are reacting to the volatility of every market that you're invested in. Because if you are a value investor, my assumption would that you're not looking to trade
We're
at
not,
every moment.
We're not traders. There's a wonderful story.
Right.
Chris Brown at Tweedy Brown tells a story of how they were interviewing somebody to come and to come join their firm. And after the interview, he's walking the fellow to the elevator. And the fellow says, you know, it's amazing here at Tweedy Brown. At most firms, you can tell from the atmosphere in the place whether the market's up or the market's down. At Tweedy Brown, you can't even tell if the market's open. And I think it's like that at our firm. We're making medium to long-term investments, 3 to 5 years or longer. And so we're not really that interested. The only reason we care about the gyrations is so we can buy something even cheaper.
Do you like bad times then?
You know, we benefit from volatility.
And distressed debt and everything else.
We provide liquidity when people want to sell things in a hurry. Presumably, it's a transaction between consenting adults. When somebody owns a bond that was AAA and now is triple C, they want to sell, they want liquidity. We sort of our rhythm is opposite most of the market's rhythm. We buy things when the market's down, we sell things when the market's up. Do I root for bad times? Of course not. I love our country.
I didn't mean it that way, bad times, but
is it frustrating when the market goes straight up and up and up as it did from 82 to 87? It was frustrating, and I worry because just at those times, it's when the little guy gets sucked in, and the little guy finds it irresistible when the market's going higher and higher. The little guy gets pulled in by stories from their neighbor, stories at the cocktail party, and they hear about how much money people are making in the market. Charlie, you probably know this, but the return from all mutual funds in the 1990s was 600 basis points higher than the average return from the investors in those funds during the same period. And that's because they get in at the wrong time and out at the wrong time. So that's painful to me.
So what is your lesson?
That's why I wrote the book, to try to educate the average person, but only like a few hundred of them read the book.
I hope I'm going to get a copy of this book. But can you talk to us about your philosophy of timing? Is there no philosophy of timing because you're looking at value and that you understand value and essentially the big decision for you is the buy decision more than the sell decision.
Buying's easier, selling's hard to know when to get out. There's no timing element. You can never tell how big a bargain you might get offered tomorrow. If somebody comes along and wants to sell you $1 for 50 cents, you can never know if they'll want to sell to you at 40 cents tomorrow. So you need to buy it and leave a little room to buy more, and maybe someday spend your last dollar and buy the bargain, and maybe it goes down before it goes up. So you always are checking and rechecking your work. The critical thing, the thing that would cause you to lose your confidence when you're doing that would be if you realized $1 wasn't $1. You thought it was worth $1, but Greece failed, or the euro fell or collapsed, and all of a sudden your dollar is only 30 cents, and now what you thought was a bargain is overvalued. So that's the dilemma. it's not so much figuring out what it's worth today, it's making sure it'll still be worth that same thing or approximately that same amount tomorrow. So a lot of stocks are cheap for a reason, and often a value investor will figure out the reason because everybody else has gotten sick of a management raping and pillaging a company, overpaying themselves, deploying capital poorly, taking advantage of the shareholders with free stock or huge options awards, or hiring their brother-in-law. So there are stocks that have been perennially undervalued because they're run by somebody who fits that profile. A novice value investor will come along and say, well, that looks awfully cheap. And Graham and Dodd didn't really place the quality of management as high as they might have. And so good managements add value. Good managements have lots of levers they can pull. They can buy back stock when it's undervalued. They can use the stock as currency when it's overvalued. Bad managements will think only about themselves first. And so those are early lessons, but profound lessons that I learned them well.